How would you like to have a portfolio that can withstand any economic environment, especially a recession? That's what Ray Dalio, one of the most successful investors of all time, claims to have. He is the founder of Bridgewater Associates, the world's largest hedge fund, and the author of several best-selling books. We will explore his latest portfolio strategy, which is based on the concept of risk parity and diversification. So stay tuned to find out how he does it. Ray Dalio is one of the most successful investors of all time. He is the founder of Bridgewater Associates, the world's largest hedge fund, which manages over $150 billion in assets. Dalio is also known for his deep insights into the global economy and cycles that drive it. In a recent interview, Dalio shared his views on how to create a portfolio that can withstand any economic environment, especially a recession. He also revealed his current asset allocation and why he prefers cash over bonds. Yield dynamics, Treasury and CD rates. One of the key factors that Dalio monitors closely is the yield dynamics, or the relationship between interest rates and bond prices. He believes that interest rates are the most important driver of asset prices, as they affect the present value of future cash flows. Currently, the yield dynamics is showing a significant divergence between short-term and long-term rates. For example, the yield on the 30-day US Treasury bill is around 5.5%, while the yield on the 10-year US Treasury bond is around 3%. This means that investors can get a higher return by holding cash equivalents, such as Treasury bills, than by investing in long-term bonds. Dalio prefers to hold cash equivalents in this environment, as he expects interest rates to fluctuate and possibly rise further in the future. He argues that cash is a better hedge against rising interest rates and inflation because it preserves the purchasing power and offers flexibility to buy other assets at lower prices. He also cautions against buying debt instruments such as Treasury bonds despite their lower prices. He explains that these instruments are essentially loans to the government, which may not be able to repay them in the future. He predicts that the government will either default on its debt or print more money to inflate it away, which will erode the value of the debt holders. Turning point: economic acceleration. Dalio identified a turning point of acceleration in the economy, which he defines as a point where the rate of change of growth and inflation is increasing. He says that this point is usually associated with a shift in the economic cycle, from a period of low growth and low inflation to a period of high growth and high inflation. He warns that this acceleration has important implications for the economy and the markets, as it creates pressure on the debt and monetary system. He says that the acceleration is driven by several factors, some of which are below. The fiscal stimulus has boosted consumer spending and income, but also increased the government deficit and debt. The money stimulus has lowered interest rates and increased the money supply, and also created asset bubbles and inflation expectations. The supply shocks have disrupted the production and distribution of goods and services, leading to higher costs and shortages. The demand shocks have increased the consumption and investment of goods and services, leading to higher prices and wages. Dalio says that these factors are creating a positive feedback loop, which amplifies the acceleration and makes it harder to control. He says that this loop is similar to what happened in the 1970s, when the US experienced stagflation, or a combination of low growth and high inflation. Supply-demand imbalance, bonds and market dynamics. Dalio explains the supply-demand dynamics in the bond market, which he considers to be the most important market in the world, as it determines the cost of capital and the value of money. He says that the bond market is facing a major imbalance, as the supply of bonds is exceeding the demand for bonds. He says that the supply of bonds is increasing because the government needs to issue more debt to finance its spending and service its existing debt. He says that the demand for bonds is decreasing because investors are losing confidence in the government's ability to repay its debt and are seeking higher returns elsewhere. He says that this imbalance creates a risk for the bond market, as it could lead to a sell-off of bonds, which would push up interest rates and lower bond prices. He says that the sell-off could be triggered by several factors, such as the following. A rise in inflation expectations would reduce the real return of bonds and make them less attractive. A loss of faith in the government's fiscal and monetary policies would increase the perceived risk of holding bonds and make them less desirable. A shift in investor preferences, which would favor other assets, such as stocks, commodities, or cryptocurrencies over bonds. He says that this sell-off could have a negative impact on the economy and the markets, as it would increase the cost of borrowing and reduce the value of money. He says that this impact could be mitigated by the central bank, which could intervene in the bond market by buying bonds and lowering interest rates. However, he says that this intervention could also have negative consequences, such as the following. A dilution of the money supply would reduce the purchasing power of money and increase inflation. A distortion of the market signals would create moral hazard and misallocation of resources. A loss of credibility in the central bank would undermine its independence and effectiveness. Dalio's all-weather portfolio. Dalios' portfolio strategy is based on the concept of risk parity, which means balancing the risk across different asset classes rather than the amount of money. He calls it the all-weather portfolio because it's designed to perform well in all 4 possible scenarios: rising growth, rising inflation, and falling inflation. The all-weather portfolio consists of the following asset allocation: 30% stocks, 40% long-term bonds, 15% intermediate-term bonds, 7.5% gold, and 7.5% commodities. Dalio explains that stocks are good for rising growth but bad for falling growth. Long-term bonds are good for falling growth and falling inflation but bad for rising inflation. Intermediate-term bonds are less sensitive to inflation but still provide some stability. Gold and commodities are good for rising inflation but bad for falling inflation. By diversifying across these asset classes, Dalio aims to reduce the volatility and maximize the return of his portfolio. He claims the all-weather portfolio has delivered an average annual return of 9.7% since 1984, with a maximum drawdown of 11.9% in 2008. Dalio's stance on cash and bonds. However, Dalio admits that his portfolio is not immune to the current challenges facing the global economy. He warns that the world is entering a new paradigm where interest rates and inflation are likely to rise, and debt levels are unsustainable. Dalio advises holding cash temporarily instead of investing in bonds. He argues that cash is a better hedge against rising interest rates and inflation because it preserves its purchasing power and offers flexibility to buy other assets at lower prices. He also cautions against buying debt instruments like treasury bills despite their high returns. He explains that these instruments are essentially loans to the government, which may not be able to repay them in the future. He predicts that the government will either default on its debt or print more money to inflate it away, which will erode the value of the debt holder. Dalio's perspective on the economy and the markets is based on his deep understanding of the historical and cyclical patterns that drive them. He's developed a comprehensive framework of principles and criteria to evaluate the attractiveness of different investments based on their expected returns, risks, and correlations. Dalio says that he currently holds around 25% of his portfolio in cash and only 15% in bonds. He expects to deploy his cash into other assets such as stocks, gold, and commodities when the market conditions change. Market misconceptions: performance versus quality. Dalio also criticizes the common misconception that markets performing well are always good investments. He points out that the stock market has been boosted by the unprecedented monetary and fiscal stimulus, which has created a disconnect between the market and the real economy. He warns that the stimulus is not sustainable and will eventually lead to higher taxes, lower profits, and lower growth. He also highlights the danger of recent bias, which is a tendency to extrapolate the recent past into the future and ignore the long-term trends and cycles. Dalio advises investors to look beyond the short-term performance and focus on the quality and fundamentals of the assets they own. He suggests using a framework of principles and criteria to evaluate the attractiveness of different investments based on their expected returns, risks, and correlations. He also recommends diversifying across different countries, sectors, and themes to capture the opportunities and hedge the risks in the global economy. So, what do you think of Ray Dalio's recession-proof portfolio? Do you agree with his perspective and strategy, or do you have a different approach? Let us know in the comments below. And if you enjoyed this video, please give it a thumbs up, share it with your friends, and subscribe to our channel for more videos like this. Thank you so much for watching, and I'll see you in the next one.